Welcome to this little mini course on quarterly estimated tax payments. We're going to talk about what these are, how to calculate them, and then if you're watching this video in January, how to use your quarterly estimated tax payment to control the true-up due in April. In order to properly understand your quarterly estimated tax payments, you have to understand how you first pay your taxes. Let's outline that. So let's pretend that the total taxes due for the year for you are $225,000. Later, we'll come back to describing how to come up with this number. But for right now, let's pretend that the total personal federal taxes due for your household is $225,000. Now, there's three ways you're going to pay these taxes over the year. So the first way is through your paycheck. This is your normal W-2, and it's going to be by the withholdings on your paycheck. Now, I don't know how much you're paying yourself on your pay stub and how much you're withholding. That's actually a whole tax strategy in itself. So let's just pretend, for the sake of learning this, that you're withholding $25,000 per year from your W-2 paycheck. So if you owe for the year, if you're going to owe $225,000, and you're going to pay $25,000 through your W-2, that means that there's $200,000 left that you have to figure out how to pay. The second way that you pay your taxes is with your quarterly estimated tax payments. These are made 4 times a year, and they're generally made after the quarter closes. Now, that's different for the June payment. The June payment is right smack in the middle of Q2, and it is the payment for Q2. I do not know why the IRS does this, but that's the date. So you're going to pay money with your quarterly estimated tax payments in order to get the total paid in. So if you're withholding $25,000 from your paycheck for the year, you're going to have $200,000 left. So let's pretend that we actually withhold $25,000 and then we pay $50,000 4 times per year. So we're going to be paying a total of $200,000 this way because there's 4 estimated payments, $25,000 this way. So the third way that we pay is what I call your April true-up. And the April true-up is when you get to pay the difference between how much you owe and how much you've already paid. Now, in this specific example where we owe $225,000, we're going to be paying everything already through our W-2 and through our quarterly estimated tax payments. So in this example, we would actually owe nothing in April. Now, this could be a little bit different. Let's pretend that we're still withholding $25,000 through our paycheck, but let's pretend that we're doing 4 payments of $40,000 for our quarterly estimated tax payment. So now we're only paying in $160,000. Okay, so we now have the $25,000 through our payroll plus the $160,000 that we're paying through our quarterly estimated tax payments. So now we actually have an April true-up. In this case, we've got $160,000 plus $25,000. That comes to $185,000. So $185,000 less $225,000. We're going to owe in April $40,000. Now, here's another alternative. Some people like to do it this way, and we're just going to go through this as an example to illustrate how this concept works. Let's pretend that I withhold 0 through my paycheck. Okay, so I'm not withholding anything through my W-2. And let's pretend that I choose to make a $50,000 per quarter estimated tax payment. This is perfectly legitimate because what will happen is I've now paid in $20,000 or $200,000. I owe $225,000, so my April pay up is now $25,000. And you get to decide how much you want to pay through your paycheck and how much you want to do for your quarterly estimated tax payments. So that's the basic concept of the 3 ways that you get to pay your taxes. Now, let's just talk about the emotional impact of each of these 3 ways, because this is going to get us into the discussion of what you should do for your specific situation. If you choose, let's go back to a pretty typical scenario where we're withholding from paycheck. And let's say that my quarterly estimated tax payments are $40,000, which means I've got a $40,000 April true-up. When you withhold money through your paycheck, you don't see it. It just happens automatically. and you get used to seeing your paycheck deposited. And that's a very comforting thing. And so the number one method of paying through your W-2 is emotionally very comforting because you don't miss it. In fact, you may not even realize how much you're withholding. Whereas your quarterly estimated tax payments, these have a little bit bigger emotional impact on you because you've got to plan for them. It's a big number and you're paying that money once every 3 months. And so if you're able to plan through this, for example, if you're using the cash consolidation process that we use here at FirmStride and you've implemented that, then this $40,000 is nothing to worry about, as you know. It's just part of the system. But if you're not using that, then this can be a pretty scary number because it comes at you early January, right after you finish the big Christmas time. It comes in September, right around the time that you might be owing other things. In April, you've got a quarterly estimated tax payment right at the same time as your previous year true up. So this can be emotionally difficult for people if they don't know how to plan for it. And then this is the thing, the April true up, which has the biggest emotional impact on people because they never know what the number is going to be. And so people, they get worried and they're kind of wringing their hands worrying, what's my paycheck? Am I going to get money back? Am I going to owe money? Well, now you know, this is just simple math. You know in January how much you're going to be paying in April, even before your accountant gives it to you, as long as you know this number. So this number tends to have an emotional impact on people because when they get money back, they say, yay, I got money back on my taxes. But in fact, that's just your true up. Getting money back is actually not an indication that your taxes are good. It's actually an indication that you overpaid your taxes. In fact, in this example, let's illustrate that. Let's say that I've got a $225,000 tax bill and I pay $60,000 per quarter. So now I've got $240,000 paid in here, plus another 25. I've paid in $265,000. And so guess what? Now I'm going to get $40,000 back in April. So getting money back is actually your fault. It's not your accountant's fault. It's not an indication that your taxes are good or not. So now that you understand the basic concepts of how quarterly estimated taxes work, let's talk about how to calculate this number for what's right for you. There's a way to figure out your quarterly estimated tax payments even if you don't know your total taxes due. So let's walk you through this. So there's two options for how to calculate your quarterly estimated tax payment appropriately. The first one is called Safe Harbor. And the reason it's called Safe Harbor is that if you pay in using option one, the amount of taxes quarterly, then you have no tax penalty. And the nice thing about the Safe Harbor method is it's based upon your previous year's taxes. This is the technique that your accountant's going to use because they want to avoid penalties and it's easy to calculate because we have last year's tax numbers. We don't have this year's tax numbers. So we're recording this video in January of 2025. So we don't have 2024 yet, but we have 2023. And the Safe Harbor method it uses the previous year's tax return. So what you do is you take the previous year taxes due. And if you're watching this video in 2025, that's your 2023 Form 1040, Box 24. That's got your total taxes due for 2023. So you take this number and you multiply it times 1.1. So the rule is that if you pay 110% in, then you won't have a tax penalty. You have to get within 90% of your actual number or pay in 110%. So the Safe Harbor method uses the 110%. So let's say that we look up last year's taxes and we multiply this times 110. Let's say my last year's taxes were $180,000. I take that times 1.1. I don't have a calculator here, so let's kind of do this by hand. So let's see, 10% would be 18,000 plus 80, that's $198,000. Let's just round that up to 200, just for the sake of conversation. And by the way, when you're doing quarterly estimated tax payments, it's okay to round like this because we're just trying to get in the ballpark. So I've calculated that if I pay in $200,000 in my taxes before the end of the year, before the end of the January deadline, then I've paid safe harbor. Now, that doesn't mean that I won't owe in April, because let's take a look at how this works. Let's go back to the three ways that we pay our taxes. Okay, so number one is going to be through my paycheck. So let's say that in my paycheck, I've paid $25,000. Now, if we know safe harbor is $200,000 and we know we're withholding $25,000 via our paycheck, well, we can just subtract those two to figure out how much we need to make through the second method of paying our taxes, which is our quarterly estimated tax payments. So 20,000 minus 25,000 is 175,000. And 175,000 divided by 4 is about $44,000. So if I pay, if I do $44,000 per quarter, that's going to result in a total quarterly estimated tax payment of about $175,000. It's a little bit more, but for the sake of math, it's 176,000. Let's just say 175. So now I've paid in through my quarterly estimated tax payments and plus my paycheck, I've now paid in the full $200,000. So in April, let's say that my total tax bill is $225 again. How much am I going to owe? Well, I've already paid in $200. I owe $225. So my true up in April is going to be $25,000. And will I have a tax penalty? Well, no, I won't, because I paid $200,000 in under safe harbor. Now, the nice thing about safe harbor is it's based on the previous year's tax return. So this is why accountants like it and why they give you those little coupons that you're supposed to somehow cut out and mail in or something. And don't do that, by the way. There's a better way I'll show you. So this is the safe harbor method, and the advantage of it is that it's easy to calculate, it's easy to do the math, and it works. The downside of this method is that you don't know what the April true-up is going to be. And the April true-up is what causes the most stress and emotional reaction when it comes to taxes. So this is something that would be better if we could somehow avoid it. And that's what the second method of quarterly estimated taxes does. But it takes a little bit more work. And so let me show you how to do this. So now you understand the safe harbor method and how it works. Let's look at a second option, which takes a little bit more work, but is definitely worthwhile. Now, if you are a client of FirmStride and you're with a coach, then they'll work with you and do this calculation with you to make sure it's right. If you want to learn about how to do it on your own, you can go to the Introduction to Tax course, and it explains this in more detail. So option 2 is, instead of doing safe harbor, is you pay actual. And this method works because if you get within 90% of the final number when you pay in your taxes throughout the year, there's no tax penalty. Remember, safe harbor is 110% of last year. This method is or 90% of actuals. So to do this, what you do is you start by looking at your estimated taxes due. Now, I want to mention if you're a Chick-fil-A operator, this is actually relatively easy to do, because you get, think about getting your FCRs. You get your FCR in December for the November month. And so that's your last payment from your FCR. It comes in December, and then, of course, you can predict your paychecks for the rest of the year. Most business owners, what they do is they don't know how the year is going to end, and they have to wait until January to figure that out. But for Chick-fil-A operators, you know exactly what the business earned to the dollar by looking at December to December, the FCR report. If you go to the second page of the FCR report, there's an owner income section that details all this. And then you just have to pull up your FCR report from the previous December, add those numbers together, and you're good to go. So anyway, there's now once you know your profit, by the way, for your business or your restaurant, that doesn't mean you know what the estimated taxes due are. It just means that you know what numbers to use. So let's say that you can estimate your taxes to be the $225,000. Like I said, some accountants will do this for you in December or early January. If you're with FirmStride, your coach will figure this out with you. So you have pretty high confidence of what your total taxes for the year are going to be. And then what you do is you basically go through the three ways that you pay your taxes. So we've got our paycheck. Well, you know your paycheck for the year, what the withholding is. If you don't, if you're changing something at the end of the year, you can easily calculate it based on your withholdings. But most people can pretty easily predict what their paycheck withholdings will be for their federal taxes. So let's say that we know that that's going to be $25,000. And then we've got our quarterly estimated tax payments. Well, we've done three in our scenario. We've done the January, or the March, the June, and the September, and now we're planning for January. So we've done three of the four, and let's say we know that let's say we're doing the $60,000. Let's say that we know that we've already paid in through quarterly estimated tax payments $180,000. And what we're going to do is we're going to adjust the January quarterly estimated tax payment so that we can very carefully control what happens in April. Because the April true up is just the final number minus your wages, minus however much you're going to put in through your quarterly estimated tax payments. So the question you ask yourself is, how much do I want to pay in April? Most people really like to go into the tax season knowing what their tax liability in April is going to be. You can choose to make it that you owe a little bit of money by making a certain January payment, or you can make it so you get a little bit of money back. I do not recommend that because you're giving the government a free loan. Ideally, you end with about a zero balance. So ideally, the April is zero. So the question is, how much more do we need to pay in January to get our quarterly estimated tax payments up? And let's calculate that. So $225,000 minus the $25,000, we have $200,000 left. We've paid $180,000 in, and so now our January payment, we know that we just need to make a $20,000 payment. If we make a $20,000 payment, we've now taken care of all of our federal taxes for the previous year, which means in April we get zero. Now there's a couple of really big benefits from doing this. The first is that now you don't have to plan in April to get a big surprise from your accountant. Okay, you know what the number is going to be roughly. Now, this won't be exact. You might be off by $1,000 here, maybe you get $1,000 back, but who cares? The whole point is you're not sitting on the edge of your seat waiting to find out how much you owe in April, because you know. In fact, you not only know, you controlled it with your January payment. The second big benefit of doing this approach is that now you can check your tax return. If you have a very high confidence from either your own calculations or from your coach's calculations of what your tax bill is going to be, when you get your tax return from your accountant, you can very quickly check it by looking at how much you owe. If you owe approximately zero, then odds are your tax return is correct. If your accountant figures out that you owe a lot of money, then we have a place to start to try to understand where the error is, or if there even is an error. Perhaps the error was made in the estimation. And if your accountant comes in and says, oh, you're getting a lot of money back, let's say you're getting $50,000 back, you'd want to understand why. Did you employ a new tax strategy that worked exceedingly well? Or did something happen in your calculations? Or did your accountant forget to include something? So knowing the number ahead of time is a great benefit. Now, to get this level of sophistication in tax planning, you need to know what your estimated taxes due are. Getting this number, you can either ask your accountant if they're willing to do it, and sometimes they'll charge you a little bit extra for that, or work with your Firm Stride coach. Your Firm Stride coach will be able to put this number together based on all the tax strategies that he or she guided you through, and then we can get a pretty good estimate of how to control that April number. The whole goal of what we're trying to do here at Firm Stride is not only help you save on your taxes, which is this number right here. We want to get this number down as much as possible. This number in April, it doesn't matter. This is the number that matters. We want to get that number as low as possible so that it's sustainable at that low level so you can keep as much of your wealth as you can out of your business. But the second thing that we want to do is we want to help you feel confident in the future. So when I say confident in the future, what that means is if you're in January, you know exactly what April is going to look like. And that gives you a peace of mind knowing that you've paid your taxes. You don't need to worry about that surprise bill that comes from the accountant at the end of the year. Now, if you're interested in finding out more about FirmStride and more about how we can help you with these numbers and your tax situation, then just head over to this website, firmstride.us/meet. And we offer a complimentary strategy session, and we can talk about this. We can talk about, are these options, one of them, interesting to you? Do you know how to execute them? Do you want to learn how to execute them? Would you like to be coached on how to calculate your taxes more effectively and to predict the future so that you don't get those surprises that nobody likes? Thanks for tuning in.